Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video we are looking at ASML. ASML is a Dutch company that designs and manufactures advanced photolithography machines which are essential for making computer chips or semiconductors. It's the only company in the world that produces extreme ultraviolet or EUV lithography machines, and those lithography machines are genuinely very important to most of the companies that they work with, including TSMC, Intel, and Samsung. Without those machines, these companies will not be able to produce those advanced chips that they do these days. So what I'm going to do is give you the overview of the company. So just the information about the company. We will look at the financial details, like for example the revenues, EPSs, and all of that stuff. We'll look at the things like the debt levels. We'll look at things like the assets against the liabilities and things like that. Then we will look at the valuations. We will compare it with the S&P 500. With the valuations, we'll check if this company is a buy right now, because yes, this company might be a great company, and we will see that in a second. But we also need to know if they are, if it's worth buying it right now, or if we're going to lose a lot of money if we did buy it right now. So we use the fast graph. We will use a Morningstar valuation. And then I'm going to give you my opinion about what I would do moving forward with this company, considering is the most, I've got more money in this company than any other company. So we'll look at that as well in a second. Okay, right. If you like this type of content and you're enjoying, please like the videos. As always, subscribe to the channel, and don't forget to join us in the Patreon account, where you will definitely make a huge difference. And one of the things that I'm doing currently is basically subscriber portfolio reviews, where subscribers are sending me their video, their portfolios, using the spreadsheet that I've shared with you guys. It's basically there. Once you sign up, you will see it. Basically, is the first thing. So download it, basically fill it up, send it to me, and then I will give you a review, and I will explain to you some of the things that I would do personally. And it's been absolutely amazing and eye-opener for me to see what people are investing, why they're investing, and yeah, some of the things that some brothers were slightly disappointed, I guess, would be with my view. Some of them were actually quite happy, and then we had a long discussions. It wasn't just a one-off thing, and after we've basically gone through, done the review, we've gone back and we had discussions about what to do, what they can and cannot do. Again, I'm not a financial advisor, but I'm just giving them based on my opinion what I think the person should do based on their age and things like that. So yeah, basically you join us if you can, and that will definitely make huge difference to the channel. Now let's talk about ASML. So like I said, this is probably one of the most important companies in the world, and right now it's trading $725 per share. So as we speak right now, it's down about 1.3%. and it has a market cap of $286 billion. It pays a small dividend of 1%, which is fine, and it seems undervalued right now based on the dividend theory valuation side of things. When it comes to dividend side of things, 82% safety, which is very safe. Okay, with regards to payout ratio, which is basically how much of their net income the company uses to pay that dividends, only 20%. So they have room to grow if they need to over the coming years. And as you can see here, for the last 5 years, they grew that almost to 22%, which is very fast, which is nice to see. And as you can see that graph, you can see basically from 2020 up until now, they have been growing that nicely. Now they have paid this dividend for 15 years without cutting, which is nice. You'll get the $7.46 for every share of this company that you own. And the next thing we're looking at right now is the earnings per share side of things. And as you can see here, from $3.21 in 2015 to right now $23 per share. And as you can see here, if we go down, you can see they're buying back their own shares. A company that buys back their own shares basically shows that, one, they have the cash. Two, they normally buy it back when the company is basically trading lower than their intrinsic values and so on. And it's nicer to see that, because this is, if you own one share of this company and they buy back their own shares, that means you now basically your one share is worth more, so you own more of the company. So it is important for us to see if a company is buying. I hate when they do, by the way. I hate when they buy when the stock is very overvalued. Okay, so it's nicer to see when they buy it back when the stock is actually trading lower than the intrinsic values. Now, the total sales grew from $6.2 billion to $32 billion per year over the last basically 10 years, which is nice to see. Now, the other things that we're looking at is the return on equity, which is 58% right now. Return on invested capital of 42%, really amazing. Operating margins of 35% and free cash flow margin of 29%, and debt levels is basically zero. So in terms of the profitability side of things, in terms of debt levels, in terms of shares outstanding, the revenue growing, EPS is heading the right direction, the free cash flow per share is going the right direction, apart from a slight drop in the basically next 12 months. Everything else seems fine. So let's now have a look at the liability side of things. So the income, we've more or less seen this part, the revenue side of it. But this is something I want to show you here just to quickly. This is the revenue here, this line here, okay? And this is the cost of that revenue. So this is how much they're spending, and that's gross profit. So that's basically what they take home. And of course, sometimes they pay, all the taxes and everything else they need to do, research and development and so on. And then the net income of that I think it was 19 billion, almost $20 billion, is basically about $11 billion. And some of that becomes basically the free cash flow, of course, at the end. And as you can see here, you can see the basic EPS growing every single year for the last 10 years. So it is absolutely fine. There's nothing to worry about that side of things. And finally, I'm just going to show you one other thing. That's two main things. That's the total assets of this company, which is $52 billion, against we're looking at the total liabilities of this company, which is only $32 billion. So they have more assets than liabilities. So you have absolutely nothing to worry about with regards to that. Now, a couple of other things I want to show you. This is basically more information from Morningstar. You can pause the video and have a look at. This is bull side of things, and then this bear side. So for this side, as you can see here, this is one of the reasons I've actually invested in this company, is machine that lasts more than 30 years. It says providing recurring service revenue. So that means if this product basically stays around for the next 30 years, and of course there will be wear and tear and sometimes maintenance and so on, that is what creates that recurring service revenue, which is really great. So they sell in the product itself over 300 million, and then they get that service money from the companies as well, which is really interesting. Okay, and these machines get more complex, switching cost and service revenue and potential strengths. So again, it's really important to understand that, because the machines that they're making are so complex, no one else can create those. So companies like TSMC will not be switching to another company or another new up and coming companies. Maybe China will create their own ones, but I can't see companies like Intel or Taiwan Semiconductors or whatever basically switching anytime soon for at least the next 20 years. Okay, and this is what it says here. ASML has potential to improve gross margins in the next decade. And the final thing is here, this part here, we expect low double-digit annual revenue growth in the next decade, which is absolutely amazing. And of course, at the bull side, it basically sells low volume, high price, of course, of product. Lithography machines represent a high proportion of the customer costs, of course. So if the company fails to innovate, then the customers will look for alternatives. Now, those alternatives do not basically exist right now, but I can't imagine the company stopping that. They're spending a lot of money making these machines. And a couple of other things is basically with China's situation, basically they're saying the ASML growth trajectory will suffer, of course, because of what is happening with China. Now, that can easily change, and if even it doesn't change, the fact that the main customers for this company is Samsung, TSMC, as well as Intel, I can't imagine basically this being a massive impact on the company. It can change, by the way, it can happen, but right now I don't think that will matter too much. We've seen all of this now. So what is the next step? The next step is, yes, it's a great company, financially healthy. Now, is it the right time to buy? And that is something you always need to ask yourself as an individual investor. And this is what we're going to do now. So looking at this company, as you can see here, we've got 4 stars here for this company. It's been like this for quite some time. Okay, this is Morningstar valuation, and $890 per share is where they think price should be. And as you can see here, okay, this is basically actually the trading in euros, but you can see 800 is basically the euros version, by the way, and the dollar ones I think was 900. In fact, let me just search ASML and I will get Here we go. I just wanted to show you this in USD. So you can see $960 per share is where they think the price should be. The company, of course, has a wide mode, and those are the 4 stars. So valuation side of things, it seems cheap right now. Basically, based on like what we have around at $723 per share in comparison to that 960 where we think we should be. The next thing I want to show you is basically a bit more valuation and how it has performed against the S&P 500 over those period of time. So if we click historically, you can see if I click max, for example, this company was trading below. So normally what we're looking for below that orange line is the earnings, for example, and normally price should track the earnings, but this company has not been doing that since 2013 up until now. Is basically been going up every single year to the point where basically around this June this time last year, actually 30th of June, basically the stock was how much was it? Let's have a look at it again. $880, almost $900 per share, and basically where it's supposed to be right now, basically intrinsically, that's where it was this time last year. So it looks very expensive looking in this graph. The other thing I want to do now is to look at the forecast, because that's the important part. So as you can see here, they're expecting the earnings to grow. In fact, if we go back here, I want to show you the earnings growth for the next at least 5 years. So at least you have the full picture before we move on to the valuation side of things. So 2025, they're expecting almost by the time we get to December, basically they're expecting the earnings to grow about 39% almost. That's EPS, right? That's just estimates. By the way, this is just estimates. Anything can happen. Things can easily change. Now, with regards to the revenue side of things, about 27%. But look at this, 7% when it comes to the earnings side of things in December 2026. 2027, basically we're looking about 21%, then 11%, then 20%, and so on. There's a lot of analysts looking at these companies. Now, this is why I always say to you guys, semis are very cyclical businesses. 1 year they're up, the next year they're slightly down, then they're up, then down. And you have to be able to have the stomach to be able to survive that sort of a thing. So when they go down, you buy more and you just leave them alone if you believe the company will bounce back. Okay, and same goes for the revenue. So now we know that it's very cyclical and things can easily go up and down and change. Okay, we're looking at about this much, and the next year it's about 5% according to his fast graph, and then the year after about 19-20%. Now, based on that, if we look at the normal estimate, which is basically what this company has been trading over the last whatever years, what basically based on that 16 PE, right? If you bought it right now, you'll be losing about 20%. So you will be losing for your 10,000 will become about $8,000. So you will be losing 20% of your money, of the entire money. If you use the normal multiple, which is basically what Mr. Market likes to trade this company and what it has been trading, which is that 40 PE, and you think the earnings is gonna stay up and whatever, then you will be making about 94% on your money. So your 10,000 will become 19,467. So you're doubling basically your money, basically 100% up from what you paid for. So you're gonna have to take in between, and this is why I like basically companies like Morningstar Valuation, because 960 is very realistic for me to say that basically we look at expecting multiples of 40 is, I think that's unrealistic, and this is maybe not what I would say where the company would be trading. 16 PE is very low for this company. Historically, it hasn't been that way. So I would definitely say basically take a bit of caution, but that 96 is probably where I would be comfortable basically valuing of this company right now as we speak. So what is my plan moving forward for this company? I'm just gonna hold on, just pause the video if you need. There's a lot more information. I don't want to make the video any longer, but one of the reasons why they said what they said is this reason here, why basically they're saying this company is the top lithography equipment provider in semiconductor foundries for the least the next 2 decades. And for that reason, Basically that's why they're giving the valuations that they've given. So you can pause the video and have a quick read if you need to, but I'm going to move on back to here. Now this is, like I said, is one of the companies, one of the biggest holding I have in my portfolio. So £9,120. I'm only up about 3% right now. So I was in the negative not long ago. I've got 17 shares. I will show you my average, which is basically $656 or 521, about 17 shares. Now if actually just if it goes below, so my average, as you can see here, is 650 something. If it goes below 700, I promise you I will be buying more. Okay, so if it goes below that, I will try and add another 3 shares just to round it up to basically that 30. Why? Because I know for the next 10 years I will be holding on to this company without selling and just leave it alone. So that's my long-term plan. I am not planning to add it to right now, despite being cheap, but because I'm only up about 3%. If we've seen it, so it can easily drop 5-10% in the next couple of days. So I'm looking forward to to the time where it actually drops below 600, and if that happens in the next few days, then I will be loading up again, and I'll let you guys know inshallah when I do it. So yeah, that's what I wanted to share with you guys. I've got a few more videos planned for us. If you can join us Patreon account, send me your portfolios, and genuinely you get a lot out of it, just not this. I've basically been sharing quite a bit in the last few days. I'm on holiday right now, but I'm traveling, but I have been basically putting a lot more effort into giving a lot more information for the brothers and sisters who actually subscribe to the basically either the support work or the intelligent investor. So join us if you can, inshallah. Have a wonderful day. Assalamu Alaikum.